Hey everybody, welcome back. Let's talk about these butterflies, and we're going to use some real world examples in this one. So far, we've been using the analysis tab, and we've been projecting forward what the value of the option could be at expiration. But Thinkorswim actually has another part on its platform called ThinkBack, and with ThinkBack, you can actually go back in time, build the trade, and see how it actually would have made or lost money with the real actual facts in place and not just some hypothetical of what might or might not have happened. So in this example, at the first of the year, on Friday, we would look to put on that butterfly for the following Friday. You can see that this one would be a successful trade, and the target strike price is going to be the 325.5. I remember in some of the earlier videos I had mentioned the fact that this blue line may or may not end up at a strike that actually suits you, right? We could use the 326, we could use the 325. There might not even be a 325.5 that we can use. All right. Now you can also recognize that on Wednesday, maybe during the pre-market or the overnight hours, SPY got to that number. And it's important to recognize we couldn't have traded the options at that point, right? So even though we see a wick at that blue line, that doesn't mean we actually had an opportunity on Wednesday to close that trade. You can see where the market opened, which was down here, and where it closed, which was up here. So perhaps in the day, it had opened and ran all the way up there and ran back down and closed here. Unless we go into the intraday on that time frame and actually take a look, we just don't know. Right? But what we do know is that we did get to that number on Wednesday. We came very, very close to it on Thursday. On Friday, we passed through it, and then we closed just slightly above it. So we flirted with that line multiple times on multiple days. Let's go take a look at what the actual trade would have made and if there was an opportunity to close it with profit before expiration or at expiration. To get there, we want to go to the Analyze tab and we want to choose ThinkBack. Now, if you've never been in this part of Thinkorswim before, you need to first tell it what you're looking at, and for us that is SPY. And then you want to come right over here in the upper right corner and you want to pick the date that you want to put the trade on. For us, we're looking at Friday the 3rd. You can see here in the calendar, it's January, Friday the 3rd, and that is the date that we have. And if I scroll up in this options chain, you can see that the date on the options, the 0-day options, is January the 3rd. This is, in all intents and purposes, exactly like Friday the 3rd. Okay, so we're going to scroll down 1 week and we're going to look at options a week out, and we're going to choose the 325 strike. Now they do have a 325.5, and we can choose that. So let's just go ahead and choose right at the money, the 325.5. And now let's also make sure that our trade is equally balanced in both directions. From the 325.5, we'll grab the 327.5, and that is $2 up. And we'll grab the 323.5, and that is $2 down. So now we have an equally balanced butterfly. Right now where my mouse is, I'm on January the 3rd. The following week, the market opened on a Monday, and you can see that the line showing a little bit of profit there, not a lot, right? It actually showed that the profit began, and it went down from there into Tuesday, and then it started to move up. Now at this point, we're at $28. Well, we paid $38. Okay, our break even is the 0 that you can see, and we're not there. It would be underneath 318. So we're not losing money. We're not below our break even, but we're not very profitable yet. Now, On Thursday, we actually decreased in value between Wednesday and Thursday. And look at what we did in the valuation of the stock price. We jumped across that line. So we were underneath our target. Now we're over our target. And when we got over the target, we actually lost value in that trade. And then we get into Friday. So from Thursday to Friday and into Friday at the close, this thing exploded in value. And it went from $24 to $142, and then it faded back down and expired at $140.50. For something that we got into for $38, we'll just round up and call it $40. We made $140 if we held it all the way into expiration, which we would never ever do, right? We don't want to do that because we don't actually want the shares. But we could ballpark this and say, I think I could easily have closed this at around $100 at some point during the day on this day. So now you can see when you're in these butterflies, you have to be patient. Monday, Tuesday, Wednesday, and Thursday did not look good on the P&L at all, even though we were right inside the range we wanted to be in, right? We were in the 10th, the sweet spot. And yet the P&L just looked absolutely horrible until Friday. And then this thing really took off. Okay? So that's exactly the kind of market you're going to need to be prepared to deal with. That the P&L is going to lie to you. These trades are going to look like they're losing. You're going to want to bail out in advance. But you need to give the trade time because the butterfly is most profitable right at the very edge of the day on the day of expiration. Now, I really do not recommend playing chicken with the market. I can't stress that enough. You don't want to try to hold these until 3:55 in the afternoon and then look to start getting out of your trades. Don't let greed wreck you. Because if you get a sign, that's not our fear, right? The broker, our trade is covered, first of all. So we wouldn't actually have to take assignment of any shares. We wouldn't be on the hook for thousands of dollars. But we would be on the hook for the $60 in fees because there's 4 legs and each leg is going to cost us $15 just for them to, quote, manage the position. And there's no way we want to give away $60 of profit in this trade. Okay, so we're not scared of the assignment. We're scared of the fees. Let's avoid those by closing these trades out early. So this is one example. And I did pick a winner because we already know what a loser looks like. I don't have to demonstrate to you what it would look like if you lose your $40. I'm pretty sure you've all experienced that on your own. So I'm going to pause now, and I'm going to go and look at another opportunity, and we're going to rebuild another one. All right, so I've made another one now, and this one started on the 7th of February with a target of the 14th of February on the blue line, 337. I made it $2 wide. It cost us $30 to get in it. And you can see that the trade topped out and never faded back. So 111 was the max profit that this trade actually would have made if it was put on. We know that we can't realistically expect to hit that max profit. But if we spent 30, made our 30 back, and was able to also get 111 in profit, that would have been one heck of a trade. So in this, if we look at this from a perspective of, say, $70, then we doubled our money, right? We made back what we paid, and then we made an extra $70. So when you make back the part that you paid, that's not really considered profit, right? That's just getting back to break even. So if we look at it from break even onward, $70, we doubled our risk in the trade. We risked 30, made 70. That's a 200% profit, right? That's not a bad target, and we're cutting ourselves short. This trade may have easily made more than 70, but when you're doing this kind of work and you're doing this kind of back testing, aim low. Don't assume, well, the trade closed at 110 111. I could have easily closed it at 105. That's not necessarily true. Don't make those kind of projections. Project to the low side. So we're going to say that we could have closed this trade at $75. One of the things that's worth noting is the market closed on Thursday on the penny, right where we needed it to be. And yet, on that Thursday, the trade would have only been at 100% profit. Actually, a little over that, right? We'd actually say 1.5% profit, so 150% on Thursday. We only got to 200% on Friday. On Wednesday, the trade had already made 100% profit. So we made back the 30 that we had spent, and then we made another 30 on Wednesday. That's not bad, guys. Which means clearly we could have closed this trade down, locked in profit, and not have worried about the end of the week at all. There's nothing wrong with 100% profit. Now, the reason I don't necessarily recommend doing one or the other is, yes, we always want to lock in profit. So if you had more than one, maybe you close that one down at 100 and let it run. The second reason that, from the other perspective, is if you let it go and you can at least get 150 to 200, then it's going to cover the times that you lose. Now, remember, this has a very high win rate with nothing more than just using the top line. If you don't try to pick and choose the bottom of the top, and you just always pick the top line or no line at all, if that is your two choices, this has a very high win rate. So even at 40%, that is 400 times better. Okay, maybe I got too many percentages in there. Call it 300 times better than the average butterfly. It's still drastically impressive. So closing it down at 100 is fine. It would be good to fade out. So if you had two or three, maybe close down one at 100%, and then look to close the others at 200 or 300%. And this is one of those few trades where I actually encourage people to stay in it past 100%. Normally, especially with credit spreads, I encourage people to shut down at 15, 20, 40% profit. And you absolutely could do that with these kind of trades. But the thing is, a butterfly normally only wins 10% of the time, and you need that really great risk to reward ratio to be able to cover 90% of the losses that you would make, right? So, the beauty of the butterfly is that you normally can hit a 300% when it does win. Well, let's not take that away from us. Even though we're still not losing 90% like a regular butterfly, we don't want to give away even a little bit of edge. So, it's a delicate balance between wanting to lock in profit and letting a runner run. And really the only way that you can do that effectively is if you have multiple units or opportunities, right? So if you had bought 2 or 3 of these and then was able to scale out, you could easily have taken this up into the $75 range. I could continue with these examples, but I think you get the point that you can go in and you can build these trades using the think back. You want to make sure that you have the date set for the day that you actually want to get into the trade using the upper right calendar. Okay, that's very important to recognize. This calendar down here, not as, it's not as important. You can see that when I'm changing things around down here, things aren't, the only thing it's really showing is the P&L at, these numbers. It's not affecting what we're looking to find, which is our profit, and that's the yellow line here on the chart. All right, guys, that's all I got for this. I appreciate your time. I look forward to seeing you at the next video.